You're the accountant who launders millions for the cartel. You stare at a deposit confirmation for $2.3 million, routed through a laundromat chain that washed its last real shirt in 2019. Your name authorized every line. Your credentials sit in the signature block. Your license number is printed at the bottom of a document designed to make dirty money look like folded quarters and fabric softener sales. You are the accountant who launders millions for the cartel. And the worst part isn't the crime. It's that you applied for the job. Not directly, not knowingly, but when a former colleague from your audit firm calls you 18 months after you left public accounting, drowning in $94,000 of student debt, scraping by on freelance bookkeeping and tax prep, and says he knows a group that needs private financial consulting, you don't ask the right questions. You ask the comfortable ones. What's the retainer? What's the scope? How soon can I start? The retainer is $11,000 a month. The scope is vague. The start date is yesterday. You sign an NDA that's 6 pages longer than any you've seen in legitimate practice. You sign a consulting agreement with an LLC registered in Delaware that has no website, no employees, and no operating history. And then your student loans disappear. All of them. Paid in full from an account you've never seen. That's when you understand the contract you actually signed. Not the one on paper. The one that lives in the silence between what you were told and what you already knew. Your handler, you'll never call him that out loud, but that's what he is, introduces himself as a liaison. Clean shoes, calm voice, business casual. He walks you through the system like an onboarding manager at a mid-tier firm. There are 2 books. One faces outward. It's the version that gets filed, reported, submitted. Sales tax, revenue projections, payroll records. Ordinary, forgettable. The second book is the real one. It tracks actual cash volume flowing through a network of front businesses, layered deposits, and integration channels designed to make illegal revenue indistinguishable from commercial activity. You learn the structuring method. Cash deposits broken into amounts below $10,000 to avoid automatic bank reporting. 43 accounts spread across regional banks and credit unions. Shell LLCs registered in Nevada, Wyoming, and New Mexico, states where beneficial ownership disclosure is functionally non-existent. The deposits feed into the fronts. The fronts generate invoices. The invoices create the illusion of economic activity. The illusion files taxes. The taxes make the money real. It is the most boring crime you've ever seen, and that's precisely why it works. You run your first independent cycle 3 weeks in. 7 new business fronts, a car wash in Tucson, 2 restaurants in Albuquerque that serve food to almost no one, a vending machine company with 300 units generating reports, but almost no actual coin, a self-storage chain, a mobile detailing service. You build invoicing templates from scratch, vendor agreements between entities you control on both sides, synthetic receivables that create paper trails for transactions that never happen. You reconcile everything down to the cent. The books balance. The tax filings are clean. A forensic team could spend 4 months and still need a warrant to see the seams. You sit back in your chair and feel something you didn't expect. It isn't guilt, it's satisfaction. The system works because you made it work. You optimize their process, reduce their exposure window by 40%, and cut their per-cycle layering cost by 1/3. You tell yourself that's just professional instinct, that you'd bring the same discipline to any client, but no legitimate client ever made you feel this essential this fast. 4 months in, the volume changes. No meeting, no discussion. The monthly flow increases from $2 million to $6 million. A second liaison appears, younger, quieter, no name offered. You're given credentials for an offshore incorporation service. A new trust account opens in Belize under a structure you designed but don't legally control. You don't own it. You don't benefit from it. You just built it, maintain it, and feed it. Your personal compensation doubles. No wire transfer, no direct deposit. Cash. Bundled, banded, left in your trunk while you're inside a grocery store, buying things you don't need so the trip looks normal. You didn't negotiate this raise. You didn't ask for expanded scope. It was imposed. Your compliance was assumed correctly because you did comply, quietly, immediately, without a single question. And that silence taught them something about you that you hadn't admitted to yourself yet. You don't set terms. You follow the ones written in the space between what's said and what happens next. Then a number breaks. A $430,000 discrepancy surfaces between the internal ledger and the integrated output. It's not your error. It predates your involvement by at least 5 months. But you're the one one maintaining the books now, so you're the one who sees it. You flag it. Professional instinct again. You send a note to the liaison. Brief, clinical. You expect a conversation. What you get is silence. 2 days of it. Then a visit. Not aggressive, not loud, calm, measured. You're told the discrepancy has been resolved. No explanation, no amended figures, no correcting entry, just resolution by declaration. You accept it. 3 days later, you notice a name has disappeared from the contact chain. A man you never met, but whose initials appeared on wire authorizations for the first 8 months of the operation. His initials are gone. His accounts are closed. His LLC has been dissolved. No one says anything. You don't ask. Your hands shake when you open the file the next morning. Your body has processed something your mind refuses to name. You go to your nephew's birthday party that Saturday. You bring a gift. You eat cake. You talk to your sister about mortgage rates and whether the school district is still good. You laugh at the right moments. You leave at a reasonable hour. You drive home and sit in your driveway for 40 minutes with the engine off, staring at the garage door. It's a question you can't answer. Your old colleagues think you're doing well. You look healthy, rested, financially stable for the first time in a decade. You've started rehearsing answers to questions no one has asked. Where does the money come from? What exactly do you do? Why did you leave public practice? The answers are clean, practiced, plausible. But each one takes something from you, a small piece of continuity between who you were and who you perform being now. You start thinking about the laundering work as a room, a sealed room you enter, do what's required, and leave. The person inside that room and the person at the birthday party cannot be the same person, so you make them two, and the distance between them grows every week. The letter arrives on a Tuesday. Arizona Department of Revenue. Routine compliance review of one of the Shell LLCs, the vending company. Not federal, not criminal. A standard audit trigger based on revenue to employee ratio anomalies. The kind of flag that gets pulled by an algorithm, not an investigator. But behind that flag is a pattern, and behind the pattern is $47 million in fabricated revenue across 18 months. You have 11 business days to produce documentation supporting the operational legitimacy of a company that has never sold a single product to a single real customer. You feel the walls of the room shift. The cartel you can manage. They're predictable, transactional. A state auditor sitting in a cubicle running ratio tests doesn't care who you are, who you work for, or what happens if the numbers don't hold. They care about whether column B supports column D, and it doesn't. The liaison offers a solution. There's an auditor, already cooperative, already compensated through a separate channel. The review can be closed in 4 days, clean, filed, forgotten. You understand what accepting this means. Your exposure now includes knowledge of a compromised government official, a new layer of complicity laid on top of every layer before it. You accept. The audit closes. The file is marked resolved. You sit at your desk that night and wait for relief, guilt, fear, anything. Nothing comes. The absence of feeling is louder than any of them would have been. You try to plan an exit. You buy a laptop with cash from a store with no security cameras. You model scenarios. New jurisdiction. Liquidated assets. Severed contacts. A plausible cover story. Every scenario collapses under the same weight. You know too much. Account structures. Routing protocols. Shell entity registrations. Liaison identities. Beneficiary chains. You are not an employee who can submit 2 weeks' notice. You are a living archive of prosecutable evidence. The door you walked through 26 months ago never had a handle on the inside. You close the laptop. You stop modeling exits. You start modeling endurance. How long can the structure hold? How long can you hold? You sit at your desk. 2 monitors. One displays the clean ledger, the version the world sees, revenue, expenses, tax obligations met. The other displays the real one. $187 million moved across 26 months through systems you designed, optimized, and maintained. You built a machine that turns crime into commerce, violence into vendor payments, blood into balance sheets. And somewhere inside that machine, the person you were became the infrastructure itself. You don't operate the system. You are the system. The cartel doesn't need to threaten you. The auditors don't need to find you. The most dangerous thing in the room has never been the money or the men who move it. It's your competence. It always was. And competence, unlike loyalty, can never be unlearned. If this satisfies the part of your brain that needs to understand how systems trap people from the inside, subscribe. The next one goes deeper.